Yeah, well, good morning. Good to see so many people here. And yeah, indeed, I'm Joost, Beaumont in daily life, working life. I'm responsible for bank research at ABN Amro, and at the ECBC, I'm the chairman of the data statistics working group. And as Luc already said, I've put together some data for you. And we talk about covered bond market dynamics this morning. I will leave all technical details for my colleagues, so it's purely a bit setting the scene. How does the covered bond market look like? I manage, in terms of managing expectations for the ones who are really deeply involved in the covered bond market, might not reveal really new insights, but it's a training session, so I also hope that there are some people not so familiar with the covered bond product. And yeah, indeed, after this morning, they will leave with a wealth of knowledge. And I can tell you, it's a boring product, but we can talk indeed days about covered bonds. And why is that? It's also because it's a very important tool for banks to fund themselves in capital markets. This chart shows, first I look a little bit backwards. These are the results of the data and statistics exercise that we do every year. So this year we will add 23 to the data, but so far it runs up to 2022. And I think it's the most comprehensive data set that there is in the covered bond space. It starts at 2003. As you can see, the outstanding amount of covered bonds, and we're talking here all currencies, private placements, public placements, I come to that in a minute, breached the 3 trillion mark last year. And that's quite remarkable. And it shows how, like I said, how important covered bonds are as a funding tool for banks. Second, now maybe going back a little bit, is because you see some yellow and green, and you see public sector mortgageships. You can wonder, what are these things? Well, covered bonds are, of course, backed by collateral. It's a secured funding tool. And most covered bonds, as you can see, are backed by mortgages. That's residential mortgages or public commercial real estate. The other part is backed by public sector loans, and a small part is backed by ship loans. And then we have a very tiny other category as well. So basically, that's one thing you can take away from this slide as well, is that covered bonds are a great tool for banks to fund their mortgage book. Then, of course, who are issuing covered bonds? Where do these, and it's only banks that can issue covered bonds, where do they come from? Well, as you can see, in 2003, it was all from Europe. But along the way, actually, covered bonds have become a much more global product. And as you can see, still, of course, the y-axis starts at 80%, so still the majority is issued out of Europe, but you can see quite some covered bonds also issued from the Asia-Pacific region, Korea, Singapore, Australia, New Zealand, North America. It's mainly only Canada, to be honest, and South America. You have a market, covered bond market in Brazil as well. So it clearly shows that also the share of non-Europe is rising as well. Now then, we are still talking about all currencies, all covered bonds. To give a view on the key countries, well, always leading the amounts outstanding league table is Denmark. It's a bit of a covered bond market on its own. If you want to know more, I know that Morten is here from Denmark, so he can explain exactly how the Danish covered bond market works. But it's the largest market in the world, with in euro equivalents more than 450 billion outstanding. And then it's followed by Germany, France. Now you can see Spain and some other countries. Then we know the countries, then maybe the currencies. What is the dominant currency? Well, it should not be a surprise. That's the euro, mostly euro. European issuers issuing in euros, so it's 65% is issued in euros. We also see domestic currency, so that is Australian banks issuing in Aussie dollar, UK banks in sterling. So that's also quite an important part. And then we also see banks, say European banks, issuing cover bonds in sterling as well, and that's then in the other currency category. So it's largely European, but of all dominated by euros. Then publicly placed, privately placed. No, maybe I can explain. Public placed cover bonds are really issued to, are sold to investors in the public market. See Bloomberg screens popping up from today, Actia, long 5-year cover bond. Well, investors look when, and Anna will tell about how that will work, whether she wants to buy or not wants to buy. So these are publicly placed cover bonds, and you have also different sizes. So you can 1 billion and above. This is, of course, the most liquid part of the market. Then you have benchmarks 500 million and below 1 billion. Others and the private placements. It also happens that issuers directly sell cover bonds to individual investors. And also this category contains retained cover bonds, where the issuer buys the bonds themselves, and they often do this for liquidity purposes, so they can use the cover bonds then as collateral at the ECB. So that's actually the biggest part of the private placement category. And as you can see, most are publicly placed, also the share of say the 1 billion is around 40, quite stable at 40%. So maybe moving then towards this most liquid part of the market, which is the euro benchmark market. These are all publicly placed cover bonds with a minimum size of 500 million, and these are all sold to investors. They can buy in the primary but also in secondary markets these covered bonds. Now, as you can see, this is a bit of a the cumulative issuance over per month. So at the end you see the total amount issued in a year, and as you can see this year it goes quite well. We're already nearing, you can see it here, 90 billion, almost 100 billion issued already so far this year. Now this gives you quite an indication of also how important the market is over time, and especially last 2 years were quite heavy in terms of issuance, and that followed actually 2 years, 2020, 21, where issuance was a bit lower, and it had to do with the ECB policy that banks could lend quite cheaply there, so they didn't have to fund themselves in the market. Now again, this shows a bit the euro benchmark market. I will speed up a little bit. A lot of euro area issuers active this year, 80% issued by European banks, and the remainder comes from other Europe and non-Europe, of course. Then in terms of maturities, didn't touch upon it yet, but of course, I think the key message here is that cover bonds can be issued across basically all tenors, although it goes up to, say, 15, 20 years. So they are a longer-term funding tool for banks, although banks can also issue at the shorter end of the curve. So that is quite the beauty of covered bonds as well, that they can be issued along the curve. And as you can see, of course, this is driven by demand from investors. And during 22-23, when we saw the aggressive rate hikes of the central banks, investors wanted to buy mostly shorter-dated covered bonds. And you can see the green and yellow bar that is up to 6 years. So last year, almost 80% was only at the short end of the curve. But you see this year already with rate cuts being expected, that the longer end of the curve is also open. We saw actually a 15-year cover bond recently. So that is also something to to keep in mind that it's an important funding tool and also a flexible funding tool in terms of tenors. And then how is the market? How are the market dynamics? Well, normally if an issuer comes to the market, they price their bonds with a little bit of a, yeah, you can say a premium, a little bit cheaper to tease investors to buy these bonds. And that you can call that the new issue premium, the NIP, new issue premium. This is a bit of new issue premium over time. You can see in 2020 during COVID, there were some French and Canadian banks that came to the market, and maybe this is also a lesson. I don't know whether others will touch upon it, but the covered bond market is a very stable product, often AAA rated, and in times of stress, banks cannot really issue senior funding, but they can issue covered bonds. So during COVID, when it broke, there were some banks coming to the market that paid up quite a bit, but they were able to do so. And actually, currently, you see quite a drop in the green line, which shows that banks hardly pay any premium. Actually, they can price their new bonds through through the secondary curve, you call it. So richer than where outstanding bonds are priced. So that this is kind of discussion. I will not bore you with that, but it shows a bit that I call it at the moment there's quite a happy marriage between issuers and investors. They are they are together here as well, and they're a bit dancing along the coastline here, and investors are happy to buy the bonds, and issuers are happy to sell them at levels. So the question is, how long will that continue? But we can discuss that with the coffee later. Then demand, you can look at this by using a bid to cover ratio. Then you just look at the order book. When a bond is priced, comes to the market, investors put in their orders, and then issuers, they print a certain size. You just take the order divided by the size. Then you get the bid to cover ratio. It's quite funny because the 50-year, that was the recently issued CAFIL, which had, it was a 500 billion deal. It had more than 7 billion books. So it was, pretty heavily subscribed. I think I need to change a little bit the legend here, but fine. But then I think another one is we saw there is we've seen a bit the issuing side of things, but of course we also need buyers of covered bonds, investors. You can wonder, who are these investors? Well, this shows a bit from 2014 onwards the investor base of covered bonds. Now, clearly, banks are heavy buyers of covered bonds. They can they invest in for their liquidity coverage ratio. Covered bonds are very attractive. They yield more than often more than government bonds, and are treated quite favorable in let's say the liquidity coverage ratio. So banks buy around 50%. Central banks, of course, that was heavily influenced by the QE policy of the ECB. So central banks are now on a declining path. And we see this year, and that's quite interesting actually, that asset managers and hedge funds are back in the game, buying around 30% of new deals. And these are there because they find it's pretty attractive to buy covered bonds. And then finally, say 5% share, it goes to pension funds and insurance companies. So this is a bit the investor base that normally is involved in the covered bond market. And then you can also, another question, of course, that needs to be answered, where do these investors come from? Well, here you see a bit the regions, and clearly what stands out is that, say, Germany, Austria, Switzerland, and this is heavily dominated by Germany, of course, are the largest buyers of covered bonds. And that maybe goes back to the fund brief that was established already in 1700 something. So it's already a product that's there for a long time, and that's also reflected a bit by this. And then you have French investors buying around 10%, UK, now Benelux. That's where the main part of the investor base comes from. So it is, you see Asia as well. I think it's maybe good to highlight because with the globalization of the covered bond market, you also see more non-European investors joining. It's still a small part, but it's likely to grow a little bit further. But most of them are, of course, from Europe. Now then, the spreads. I don't know what. There's no clock here, so then that's a bit dangerous with me. But these are one of the last slides. These are, where are covered bonds priced? Well, they're normally priced over the swap curve. You have a spread. The wider the spread, and the higher the return, and the cheaper actually the covered bonds. So covered bonds have become quite cheapened quite a bit between 22, 23. But as you can see, the spread widening has turned the corner. And in my view, I expect this to continue this year on quite positive sentiment. And of course also the strong demand that you see for covered bonds. Here you see that there is a real market with the covered bonds. It's like I said, it's a bit of a boring product, but you can choose what to buy. So here you see the different regions and the spreads, where you see core, semi-core, it's Belgium, France, and the Nordics moving roughly in line, and then you have the others. It's Central European, Eastern Europe, non-EU, and the periphery, which offer slightly higher spread. And then covered bonds versus other funding tools. You see SP, S&P, that's senior preferred, senior non-preferred. Also put in a capital instrument, it's tier 2. So if you think about riskiness, the least risky are the covereds, and the most risky are the tier 2s. Well, that's also reflected in of course, the spread levels. And what this basically shows, I think, what you need to take away from this is that covered bonds are the cheapest funding source for banks. That's maybe also referring into the first slide where you saw that 3 trillion outstanding. That is for a reason, and that's because covered bonds are a key funding tool for banks, and they this is a bit how they trade. Actually, it's quite interesting that it's a bit of a market in itself, because senior and paper and the capital moves more in line with each other, but covered bonds clearly underperformed. This is the change in the spread, so they underperformed in 2023 and are still underperforming a little bit in 2024. And this is also, I think, one of the reasons why these asset managers are back in the market. So covered bonds at the moment, very attractive product for investors as well, versus, say, other ranks of bank debt. I think, now this is maybe the last slide. This one is because I already mentioned covered bonds, I have a very high rating, often AAA. So there's another discussion whether it's a rates product or a credit product, but I don't go into detail here. But this shows a bit the pickup that covered bonds give versus government bonds. So the yield pickup. And then you can see that it's from an investor point of view, I would say more attractive to buy a covered bond than a government bond. And that explains also why, for instance, bank treasuries are heavy buyers of covered bonds. So in the end, all the charts are a bit linked to each other, and I think it shows. I hope that this presentation gave you a little bit of insight how important covered bonds are as a bank funding tool. Who are the issuers? Where do they come from? Who are the investors? Where do they come from? And where do they trade? So if there are any questions, feel free to reach out to me and the other colleagues, and have a nice day.